Hi, everyone. Welcome to today's Fireside Chat. Thank you for joining. Hope you all are doing well, just like the markets have been in the last few months. A quick update from our side. We've moved to a new office opposite Oberoi Mall at Goregaon and request Ayushi to share some pictures of that. So this is primarily where we are. So today we are going to tell you, moving back to today, we are going to tell you about what's going to happen on Monday with the markets, who's going to be the next US president, and how many medals will India win in the Olympics. Actually, kuch nahi pata hame about all this. But what we can start with is covering what are the changes in the budget with respect to taxation. So, Ayushi, could you start with that?
Hi, everybody. Just a very quick before we get Trideep on the line. Uh, Clearly, this budget had a few changes on the taxation side, and I thought it would be useful to just quickly summarize. We have taken this extract from Mint, which is which basically, if you look at the long-term capital gains tax on equity went up from 10 to 12.5%. On the short term, it moved from 15 to 20%. So that's something which does impact. Well, there's nothing which we can do on government taxes. So that's something which you take into account and move forward. There are small changes in terms of that every year the exemption has gone up to 1,25,000 from the earlier 1 lakh on long-term capital gains tax. On debt, there are some changes which have happened in terms of if you look at debt which is greater than 65% debt instruments were on slab rate, remain on slab rate. But in terms of listed debt, it has moved to from 10 to 12.5%. And there's a lot of equalization which has happened in terms of the tenor, which is what, if you look at funds which have 35 to 65% equity or debt, which or the FOFs which had got hit in the last budget changes. Fund of funds could be where the underlying are various funds where it had moved into the slab rate, now come back into the long-term capital gains tax of 12.5%. These are good instruments at times for some of the strategies which we on board, including international funds, which we were doing through fund of fund routes. So they are now, again, the taxation becomes reasonable. Earlier in the middle, due to the confusion, the taxes had really gone up. And same thing for gold or silver ETFs, etc. I'm not covering all in detail. A lot, some water has flown from the time of the budget day, and you would be aware. But in a nutshell, what has happened on equity and debt is that the long-term capital gains tax has gone from 10 to 12.5%. Short-term have moved from 15 to 20%. The long term has got more uniformly applied at 24 months, while for equity it remains at 12 months. And some of those like which had got hit, the fund of funds or international funds now get again classified into this structure. You want to move to the next slide? The other thing which is non-equity, which has got some impact, is real estate, where obviously the big change is that indexation is gone. So for long-term debt, also indexation is gone. I didn't want to cover it there, but I'm covering it here. So basically, indexation as a concept is moved away. And it's now that the uniform tax applied is 12.5%. The timeline for long-term has been made uniform at 24 months. And earlier it used to be 20% with indexation benefit. Now it is 12.5%. So that has been a big change which has happened in this budget. So if there are any specific questions, we'll cover it in the Q&A session at the end. So for now, I just wanted to summarize some of the changes which have happened. So the structure of this event would be more in terms of we will now move forward with our conversation with Trideep, followed by we will have a Q&A session where each one of you are free to ask any questions which you have. Anulekha, you want to get the things moving on?
Okay. So it's been exactly a year since we started this session on Fireside Chats, and I hope you all are finding it useful. In fact, the first one was in August 23 with Oaks AMC, where the fund has delivered a return of almost 50%. Then we had the CEO of Sundaram Mutual Fund, where the recommended fund by the fund manager, Sundaram Services Fund, has performed 20%. And the last chat was with Mr. Harsha Upadhyay, the CIO of Kotak Mutual Fund in February, where he had recommended the Kotak Manufacturing Fund. And in fact, the last 6 months, the fund has delivered almost 27%. Today, I'm very happy to introduce Mr. Trideep Bhattacharya for today's chat. He's the Chief Investment Officer, Equities at Edelweiss Asset Management. Trideep is an engineer from IIT Kharagpur and a PGDM from SP Jain Institute of Management in Mumbai. Trideep comes with over 2 decades of experience in equity investment across India and globally. Prior to Edelweiss AMC, he was instrumental in building a market-leading PMS business with Axis Asset Management as a senior portfolio manager. He's also spent a significant amount of time as a portfolio manager at State Street Global Advisors and UBS Global Asset Management. He also manages the Edelweiss Midcap Fund, which has been one of the top performing funds in the midcap category. And we have also been recommending the same since quite some time. And I'm not done with his achievements. When not occupied with work, Trideep has won various tournaments in tennis, bridge, and I think he's hands-on with a few musical instruments. Any of his batchmates here want to add something? Which is for public consumption. So let's begin. Amitabh, you want to start now?
Yes. Hi, one second. Hi, Trideep, welcome. And of course, sorry, one second. So, of course, we are very happy to have you on board. This is a session where clearly, as Anureka was mentioning, some of the recommendations. This is really not so much about the recommendations of funds, etc. That's an ancillary part of it. What we're looking really to understand from you and achieve from this session is understanding implications from the budget for our clients. And even more important than that, budget is done and dusted, is in terms of how do you see the market? Should we look at it? Because investors here we are looking at largely long term. We are not looking at trading. We are not looking at, from the concept of this conversation, is in terms of you're looking at long-term wealth building. What is it that we should be looking at? What are the building blocks we should be putting in at this stage of the market, where there's a lot of debate on whether it's overheated, not overheated, etc., etc., etc. And if we can get some insights around that, helps us navigate forward, it would be extremely useful for all of us. Of course, in the course of the discussion, if there are areas, yes, Pradeep.
I was going to say that I'll let you finish first and then answer.
Right. And as I was mentioning, in the course of things, if there are any specific guidance for us, any specific recommendations for us, we would, of course, take that gladly.
Okay. So, Adik, thanks, Amitabh, thanks, Anuleka, for this such a gallant introduction. Whether people have to say something for me or not, but I can tell you, as my batchmate, Amitabh, right from campus, I knew ye kuch acha karega. And I can see that he's really achieved, two of you have achieved, great success in the wealth management business. And in the meantime, congratulations for your new office. It looks wonderful. May you go from strength to strength and your AUM multiply like Indian markets. Happy to be here. Thank you for inviting me to your show. I'm really happy to do whatever you depend based on your questions, whatever you want me to answer. Over to you.
Right. So let's get started right away onto the budget. So why don't you give us an overview of the budget as you see it, and how is it impacting the investment landscape?
So in my opinion, this budget brought about a difference between Modi 2.0 and Modi 3.0. In many ways, Modi 1.0 and Modi 2.0 was all about economy and markets. But Modi 3.0 is about three. It's politics, economics, and markets. And if I were to start with politics, then I am sure you noticed the socks being given to Bihar and Andhra Pradesh. Talks about that they had to appease the coalition partners, and hence the allocations were made to that effect. But what is good though, the way it was done was not in the form of consumer doleouts, which don't really have an amplifier effect. What was being done is, I think, more in terms of development of infrastructure, ports, what you call aircrafts and religious tourism and stuff like that, all of which is likely to help in the direction of manufacturing-led growth, the path that India has embarked on. So even the politics was done keeping an economics in mind, but the politics was there. On the economics front, I think basically it was no new news. The interim budget pretty much nailed it. The capex focus was very much there, same as interim budget. The areas of growth, including defense, were also kind of very much in place. Like they had said earlier, the only additional area that they did in the case of economics was that they talked about job creation. And that is again a lesson learned from BJP from the last election, that for all the work that they have done, the bottom line or the bottom end of the pyramid did not see too much benefit. And that's what they look to address in the form of a few, job schemes and internship schemes, and we will see how that pans out. But a few focus on rural part of the economy along with jobs. Now coming to markets, which is the third element of the spectrum that I talked about in the case of budget, I think this is where the summary that you presented is the mathematics of it, but I think one needs to understand the direction. The direction is, folks, that the government is looking to kill the arbitrage across asset classes. I think that message, if it is not clear by now, it should be clear to everyone who is investing in India. And the sooner they sort of, acknowledge that and take actions accordingly, the better it will be. So while, on one side, we as equity investors can clip that, the long-term capital gains tax have gone up from 10 to 12.5%. But the fact of the matter is, now real estate and all other asset classes are on an even keel. And on a like basis, equity has its own attraction. So relative to what it is, I think if you look at the behavior of the markets on the day when they were announced, the market went down, but immediately it realized it doesn't really change the scheme of things overall. And putting all the asset classes in even keel actually enhances the value of equities. And that's the reason the market came back quite sharply. That's the second point I would make with regards to market. I think the final point that I would make was in the form of meaningful was basically this indexation in the case of real estate. I think that is something for your investors who have real estate which dates back more than a decade. They will have to think about and see how the asset allocation might look like going forward. From a business standpoint, the customs duty being reduced from 15 to 6% is likely a step in the right direction as they rationalize the taxes. I think overall, if I were to rate the budget between 0 and 10, I would probably give a 7 to 8 out of 10. They've done a decent job balancing the three balls that I talked about, politics, economics, and market, and came out unscathed. Of course, there are some niggles here and there which they will kind of analyze and get it right, but broadly in the right direction. Amitabh?
Thanks, Trideep. That gives a good overview. Now taking it from 20,000 feet to 10,000 feet or 5,000 feet, bringing it to our investors and folks who are trying to build wealth. What are the implications and how should they look at from either from an asset allocation, either from because of the changes which have happened, which you just talked about, what the imperative where you gave us rating of 7 to 8 out of 10. So what is different now for them to look at?
I think as India, I wrote an article on this, as India moves towards Vikasit Bharat, the importance of budget will actually go down incrementally, and all the policy announcements in and around budget would be of prime importance. And hence, in that context, the biggest change is that there is no change with regards to the policy continuity, which is what we were looking for as markets on the back of. Amitabh, one of the things that we as markets were a little nervous getting into this budget was that this was the first budget after BJP got a fragile mandate. So we were not sure whether overall the policy would actually be there, or they would completely become more freebie oriented or more populism oriented, and that there's a lot of doubts in the minds of market participants. And what I'm happy to report is on the post budget, the focus remains the same, which is manufacturing led growth. The focus remains the same with regards to the the areas of development, which is PLI led areas. And finally, overall, with regards to the only thing that, as you asked, what has changed, I would say the rally, or not the rally, but the markets would probably become a little more broad-based from here. I think, given the fact that they increased the allocation towards housing, affordable housing, and rural-focused growth, I would say that consumption sector in some shape or form would actually come back a little bit versus what it was in Modi 2.0. So from an investor standpoint, one important sort of checklist crossed, and we move on. Ultimately, mind you, ladies and gentlemen, its markets are all about earnings. So we can all kind of sit here and analyze as much as we can on macro, but ultimately it's earnings. It's like for fund managers, it's basically the returns that we all do. We can all come and talk, guns and roses, but ultimately it's the returns. We retain the investors or let them go.
Fair. So from a Edelweiss AMC perspective, as you look at from your investment thesis or the way you were doing, so is there anything which you talked about consumption just now in terms of areas so is there something which you all are shifting from the broad themes what you were investing in as you look forward the next few months?
Yeah. So, I can't talk about future because there'll be there's a regulatory issue to it. But what we have done over the last 3-4 months, and which is partly in anticipation of the budget and partly the budget validates the stance, is we have increased our positioning in IT and FMCG, which is IT and consumers. As you would recall, we launched a technology fund about 3 or 4 months ago, which has done quite well. But with regards to portfolio positioning, we think that, and it's got partly to do with budget, partly to do with what we see outside the monsoons and whatnot. We think that there are good days ahead for a segment of for the bottom end of the pyramid in terms of consumption, which has been lagging behind for a good while. I think the base consumption part of the economy incrementally could do a little better. So we've added our positions in there. And I think we also see in IT earnings bouncing around the bottom. Not to say that the great shakes will happen in the immediate quarter, but I think overall, over the next 3-4 quarters, as rate cut cycle begins in the United States, you will start to see IT coming into flavor a little bit. So those would be the two changes that we've made. And the third is, of course, as the markets have rallied, the valuations have gone higher, and hence, we kind of are more mindful of valuations now than where we were earlier. So that's how I would sort of put it.
Fair. So in terms of, you talked about a few sectors, obviously a few sectors such as defense, such as some of them really rallied in the run up to the elections in the last 6, 9, 12 months. So are there sectors where you have been, you said broadly that you'll be more mindful of valuations. Are there sectors, as you said, you're adding onto IT, adding into FMCG, are there sectors which you're scaling back?
Yeah, so I think we have taken some profits in industrials. Mind you, just to clear the positioning, we are still overweight capex as a team. We think manufacturing overconsumption is the theme to play. But within that, the valuation spreads have sort of, the stocks have rallied and the valuations have moved on. And hence, what we have done is from some of the high valuation stocks, excuse me, and from the high valuation stocks and from the areas within subsectors within capex scheme within industrials which have done quite well. We've taken some profits, and those have been plowed back into IT and FMCG. So that's the changes. That's the combination of what I talked about in terms of valuations, IT and FMCG. But we continue to feel that ultimately, directionally, capex as a theme, defense as a theme, power as a theme will be a strong area for people to be. But I think, as I said, in Modi 3.0, I would say a little more broadness with regards to rally. Earlier, if you look at last 1 or 2 years, it's been very polarized towards these two or three sectors. I think it will be a little bit more broad-based from here on.
That's good to hear. Broad-based rallies are always good. It gives a lot more opportunities to build out. So if you look at it from the trends, you did talk about trends on the consumption, on the we have been talking about the per capita growth going from 2,000, 2,500 to 3,000, and how that would change discretionary consumption. A lot of discussion has happened over the last. You briefly mentioned manufacturing. So when you look at trends, and now we are looking at 3 years, 5 years horizon, what are the key trends which you think would define India? And some of them you have touched already, but just looking at a trend as to what do you think we should be mindful of? Because from your vantage position, you of course have a lot more research and data which could give us some insights.
Great question. In fact, it has been a topic which I have been pondering on for a good while. And actually, I wrote an article which has come about yesterday in Hindu Business Line, which is titled Vikasit Bharat 2047, Lessons that we can learn from Japan, South Korea, and Taiwan. So what I'm going to say is basically a bit of summary from that. And basically, if you look at, and from a 3 to 5 year perspective, those are the areas that we need to learn and focus on. So if you look at what Japan did in 50s to 90s, what Korea and Taiwan did in broadly 60s and 90s is, number one, there were sustained reforms. It was not basically done for 1 5 year period and got done with. It was basically sustained for a period of good, at least a decade and 2 decades to at least speak the notes. The second thing that they did is basically focused on manufacturing-led growth rather than consumption-led growth. So that is, again, something that India has also embarked upon. But what we need to do is basically continue. And the third part, which is the most important part, is as we move towards and this is the toughest part, as we move towards basically manufacturing-led growth, we have got to find industries where we are globally competitive. And when I say globally competitive, it's an example is IT services, where we have taken share from globally, like this. If you look at Japan, if you look at South Korea, if you look at Taiwan, Japan, of course, in autos, in electronics, Taiwan in foundry, South Korea in autos and electronics. They have given birth to some of the global giants, which have really taken market share away from the rest of the world. And that is the secret to success. And that is the secret to success for India as well. For the next 3-5 years, we need to find our bearing beyond the tax stops to create globally competitive industries, and not just 3 to 5 years, but even longer. If we are able to find that, then, like I mentioned in my article, that overall the stock markets have got 10x. Japan went 65x around that time, and Taiwan went 35x. So, we have meaningful implications for stock market. Now, the limitation of the study that I'm bringing in front of you is, of course, there are many other factors which would have impacted the stock price returns as well. But if you look at the periods of economic growth in those countries and where India is, I would say that in the context of cricket, we have got a good start. The opening pair has given us a good start. We need to sort of now build on it to kind of, create a long score and long innings over a period of time. A long-winded answer, but net manufacturing-led growth is the key. Within manufacturing, where we want to operate is basically, like, for instance, if you look at, for instance, in the form of where what Japan did was over a period of time that led to kind of, kairetsu. If you don't get into those kind of, groupisms, but ultimately create industries courtesy, and PLI is a step in that direction. If you are able to promote the right industries, like for example, in semiconductors, now we have a PLI scheme which is fairly strong. So things like these will ultimately go on to create meaningful amount of industry strength amongst India. And I mean, we electronics and electrical engineers, when we passed out from IITs, had very little job to do in India, barring maintenance, and hence a lot of us went abroad. But if you look at today, if TSMC were to set up, if a lot of semiconductors like companies like Micron, Apple were to set up manufacturing in India, I see a reverse brain drain standing to happen. So, that would be my long-winded answer to your question.
Oh, fine. I think that well sums up what is happening and what hopefully will continue to happen. And all of us are invested in that, and all of us are hoping that this trend continues for a much longer period of time for India to become Viksit Bharat. If you look at, before we jump into more specifics around some funds and Edelweiss, for me, liquidity has been something which has been driving a lot of things, and that's a discussion or narrative which has been at the forefront. Even I read something yesterday which said that the funds which are coming in is significantly higher than what the uh, existing companies can absorb, and that's why the markets have been going up, and that's something which looks like set to continue. Is that something which you have any views, thoughts on that, the liquidity aspect of the market?
It's one way to sum it up, which is basically more money chasing stocks drives the price up. But I would say if you take a look at, let's say, Nifty 50, and if you look at last 5 years, I would argue that in the last 5 years, the price return of Nifty 50 is similar to the net profit growth of, say, the stocks which are part of Nifty 50. So in many ways, the share price return is very much commensurate with regards to the earnings growth that these companies have delivered. So that's the first point that I would make. Higher liquidity usually leads to valuation imbalances in the very short term, but it kind of very quickly readjusts to ultimately the earnings growth or the earnings momentum of that particular sector or subsector or the market. So liquidity can't be a long-term driver. It can kind of it can influence markets in the short term, but over time it's the earnings that will drive. So I would argue that so far, particularly if you look at large caps, valuations are still at par with 10-year average, and I would argue that over the last 5 years, earnings growth has been in sync with the share price growth despite the liquidity. So ultimately, yes, liquidity is there, but it has chased to the tune of earnings growth and not more. In mid and small caps is a separate issue, but in some segments of the market where in mid and small caps where the liquidity is low, the price return generally overshoots. But what you have to adjust for is that the growth of mid and small caps is double that of the large caps. So hence, in that sense, that there are pockets of irrational exuberance within mid and small caps, and one has to be careful of that, which is why I said that we are more valuation conscious now than what we were earlier. But we are not kind of calling any particular subsegment of the market like mid and small cap as a pariah and not investing in them. We think selective investing is the way to go.
Right, absolutely. And in fact, I had done some analysis on the relative valuations, and I had written an article in Money Control some time back as well, closer to election time, where it came out that large cap was more relatively valued as compared to over the long periods of time, while there were some pockets of excesses. So yes, absolutely agree with you on your assessment and analysis of that. Moving forward to your role as a CIO. So I have two questions, but let me ask the first question. Of course, we have had a lot of conversations over the years, and you have always been talking a lot about process, about how you look at in the investment being both an art and a science, and in terms of something you would want to educate us around, because from an audience perspective, how does a fund manager and how does a CIO look at and build a portfolio? And if any insights around that would give a lot more both comfort and confidence in terms of the science behind the selection of a fund, and how do we move ahead?
In a sense, what we are looking to do, the reason why process is essential is because only by following a certain process diligently and religiously can we make the success repeatable. Otherwise, it will be strikes of success and then strikes of failure. And in that context, we follow an investment framework which I designed at Edelweiss, which is what we call as FAIR: forensics, acceptable price, investment style agnostic, and robustness. In essence, we are looking for financially clean companies, irrespective of value and growth, companies that have return ratios more than cost of capital and are available to us at upsides more than 20%. Trust me, if these four principles, we check for financial cleanliness, we check for, overall growth rates, and not only growth rates, but also the return ratios, and we put all of this in some sort of a DCF to get to our upside to intrinsic value, if done diligently, I think is the recipe for repeatable success over a period of time. There are times when we look out of sorts, but eventually, as I said, that as valuation readjusts, we come back very quickly to normal. So I think that's the beauty of the process, that what we do is repeatable. We have managed to do that for the last 3-4 years, particularly at Edelweiss, and hopefully that continues over time.
No, we are counting on you on that. So a question around specific funds. So in case if we were to ask you at this juncture, and the time horizon is 3 years plus, 5 years plus. So we're not talking of for the next 6 months or 3 months. Which funds within your stable or within the Edelweiss group you would want us to look at, or our clients look at?
So basically, this answer, can't be one answer, because it has got to do with the risk profile of the investor. So
Yes.
I'll give you 3 choices based on the risk profile of the investor, and then I'm sure with your analytics on top, you will kind of do your 2 bits. I would say for today is not the time to be in sectoral or thematic funds, and that is where some of the valuation excesses have manifested themselves into share prices. And the issue with a thematic fund is that the fund manager is forced to be in that particular area and can't move out into any other place where there might be better opportunities. So that's the first point that I would make, that what not to do. What to do? Basically, if you are a conservative investor, then in my opinion, a flexi cap fund is the best way to invest in the current markets. If you are an investor with a reasonable risk appetite, then a multi-cap fund is a good way to invest, overall, because it has a less large cap bias. It gets you a balance between large, mid, and small, and the fund manager has the ability to switch between large, mid, and small basis where the valuations lie. And for an aggressive investors who have outlook more than 5 years, who are looking to really make wealth from markets, who don't mind the volatility, I would recommend our mid cap fund, which over a long period of time is a top quartile product. And I think the way we take the bets is that, over the last 5 years, or 15 years, it's generated something like 20% CAGR. So these are the bunch of 3 products that I would recommend, depending on the risk profile of the investor and the longevity of the time horizon of investment that people should look at. The flexi cap fund for the conservative investor, for reasonable risk appetite, the multi-cap fund, and for aggressive investor or a long-term investor, and you are the best judge for all of these characteristics, the mid-cap fund.
Oh, several of our clients have some of the funds which you mentioned in their portfolios already, and of course we thank you for highlighting that, because clearly what you said is absolutely right, and for each of our clients to decide their asset allocation, as well as it has to be a function of that. You cannot be loaded on one part of the asset allocation curve and hope to be for the long term. So clearly there's place for each one of them, and the mid-cap fund, of course, we have been tracking over a long period of time. You have been handling it personally also for a very long period of time, and that's something which we really value what you have been able to do on that fund. So what we will do, we'll switch gears a little bit. We'll try and get into, to make it a little bit more interesting, a little bit of a rapid fire round before we get into the Q&A part of the discussion.
Trideep, just to interrupt, anything on the geopolitical risk right now?
the main risk today is the geopolitical risk, Rekha. I think going forward, I think it's a good question. While we can analyze as much earnings as much as we do, going forward, the world, all of us, from an investing standpoint, need to be aware of two things. One is that over the last 3-4 years, we have been used to a interest rate rising regime. I think on a go forward basis, we will have to get used to a falling interest rate regime, which will take time to do that. Initially, the reaction to falling interest rate is actually negative of stock market, just by the way. But eventually, different types of stocks do well. So, there is turmoil ahead. Of course, we want to keep the tone of the conversation positive, but falling interest rates has its own connotation. That's number one. The second is the geopolitics. Now, with Trump coming in power, the dynamics with regards to protectionism and which sectors will he might promote India at the expense of China or Mexico at the expense of India, China, is something that we need to have a watch out for. Now, geopolitics impacts basically returns in a short period of time. People say that. But actually, if you look at over the last 3-5 years, you will find that that geopolitics, that all of us, we have moved towards a more protectionist regime than what we were earlier. And it has impacted returns in some form or other. It impacts the cost of capital. So net-net, it is an area to keep an eye on. So far, it's been a plain sailing. I think going forward, it will be a little more global and there might be a little more turbulence ahead.
Got it.
Right. On to the rapid fire first. What's the most impactful investment lesson you've learned? So quick, short answers.
Time in the market is far more important than timing the market. Trust me, this is the holy grail. There is nothing else that matters. If I were to, after having done this for close to 25 years, one piece of, one bit that I would say to everyone is basically time in the market is a lot more important than timing the market. There is no freaking comparison. Go ahead.
Well, how do you unwind after a hectic day in the markets?
Tennis. Tennis is the way to go. So every time I get some time, I play tennis in the evening. I learn, and trust me when I say this, I learn a lot more about investing in a tennis court than reading books. It talks about how you can balance the aggression with control, which is something needed in the equity markets or markets while investing.
Well, what keeps the Edelweiss CIO awake at night?
मेरे नींद के पीछे क्यों पड़े हो दोस्त? But I would say that I sleep well. But in the spirit of the question, basically, the nervousness that I have is around regulation, and particularly that the work that we do and that we are all kind of following the regulation to the code, because a little bit slip up here and there might actually have disastrous consequences. So there is a joke around in my office. The first person that or if someone wants me to pick up his call, if he calls from a risk manager or a compliance guy, trust me, even if I'm in a meeting, I pick that up, even if at the expense of some other important people in the organization. So risk and compliance, following that is something which I think is utmost in what we do, because we are dealing in fiduciary responsibility for managing other people's money, and that's what we focus on.
Can you share a memorable investment decision, good or bad, and what you learned from it?
That would be basically while I was abroad and I invested in the shares of POSCO. And going by traditional rules of investing, I invested when the price to book ratio was about 0.7 times. And coming from India, I would have found 0.7 times, or kitna sasta hoga. But that stock went from 0.7 to 0.3 times before it started moving up. And that's when I realized that what kills a value manager are the value stocks. So basically, not to hide behind the philosophy, but to understand the dynamics of the business is a lot important than just looking at just the valuation multiple.
Thanks. That's a very good insight. If you weren't in finance, what completely different career would you have chosen?
Sports. I would be in sports. My problem might be that I'm not very talented in sports. I may have be a simple maybe coach somewhere or whatever it is, but I would be in sports. I think it's a great. Apart from the benefits of staying fit and all the likes of it, I think it keeps me. I'm very happy when I play sports.
So all that you tell us that, yeah, I won this, I won that is all. You're quite good at it. Or you are bullshitting us. uh, what is the funniest or most
Trust
unexpected?
me, trust me, winning a tournament in Mumbai, which is 40 plus, and playing like the finals today for the gold medal match in Djokovic and Alcaraz are completely different kettle. I was talking about that. uh, 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 so, yeah. Go ahead. Sorry.
I understand that, of course. Uh, so if what is the most funniest or unexpected thing that has happened to you while at work?
Uh, Actually, before I kind of this Edelweiss opportunity was a bit of a surprise for me. I was managing a PMS at Access, which was a brand equity fund, and it had very good response from customers, and I thought I will retire from there. And whatever time जब तक चलेगा, जब तक लोग मेरी सुनेंगे तब तक ठीक. उसके बाद कुछ टेनिस और कुछ रिटायरमेंट दोस्तों के साथ गपशप. But I think then came this opportunity to get into the mutual fund domain. And initially, I actually didn't appreciate as much, but I warmed up to it over a period of time. And I think I must admit, sitting today where I sit, it is, it's worth taking that. So it is funny when I speak to people and they say it was bloody obvious, but at that time it didn't seem obvious.
Well, the last question, and I don't know how you'll answer that. How do our investors make truckloads of money?
So, so I would say something like this: that the eighth wonder is compounding. The way to make truckloads of money is to put it to work and not switch in and switch out more often than not. I think if you do that, you will realize, and I think all of us, I believe some of our batchmates are our customers, they are extremely strong as mathematics. But what we figure out is, I mean, if you simply do the math of compounding over multiple number of years, you will realize the magic that it brings along. So choose a fund that you like, choose an advisor like like Amitabh, and then stick to it. And stick to it for a decade or long. Trust me, there is no other way but to make truckloads of money.
Thank you. So what we will do now, we'll give you a short break to catch your breath, have a glass of water before we move into the Q&A session. So folks, whatever questions you have, you can uh, unmute and ask, or some of them you can put it in the chat and we will do that. So we'll just give Trideep a minute to just catch his breath, and then we'll start. So Anulekha, you want
Thank you. Thank you, Trideep, that there's no hamper now after this for you.
Your smile is a hamper.
Sixer, Mara. So just thought that we'll, while we give a quick break to Trideep, we'll update you all on the new products that we are doing. So we have tied up with Crystal AI for international investments. This platform brings to you options for investing across 45 countries and offers approximately 400 fund options across the globe. So this is open for NRIs and also for residents, of course, with a cap of 250,000 USD under LRS. So you could look at exploring this, especially where kids are studying abroad or as a diversification. And also, we are getting into an arrangement with a law firm for making of wills either online or with a personal discussion with a lawyer. So we'll reach out to you for discussion on this. And I think now we can get back to taking some questions where Trideep will tell us how to make money.
Right. So Trideep, so can we start the Q&A?
Sure.
So what we will do, we'll just quickly look at a couple of questions on the chat. But if folks want to unmute themselves and ask, that is also an option. These are all on this call are valued folks. So there is no filter in terms of, you can ask directly as well, or or you can put it in the chat. So right now from the chat, I'm just reading out Adarsh's message. How much economic collaboration with China is okay, and can dependency on China really reduce?
The answer is no. I think for all the anti-China noise that there is, their position is only strengthened. I think we've got to realize that China would be there in the and I mean, I think partly what I wanted to highlight in the article that I wrote is exactly this. They don't fool around thinking that China will go away. They've built some of the areas that they are present in, like chemicals. 90% of the market is China. Now, for all China plus one, we can talk all day. But the fact of the matter is, we are not even 10% of the market. So I think we need to look at the mirror. We need to sort of get building competitive industry, and it's going to take a lot of time. It's a hard work. But collaboration of China, particularly in areas in commodities where we don't have capability, is something that we can kind of explore, but not beyond that. What we have to do ultimately, and COVID was a great example to show that we need to build our own industries, and that's why in semiconductor, the government today, I don't know if you know, if you were to put up a semiconductor facility, the government will give you 75% of the capital, which has never happened ever in the world. So, that is the realization that we can't rely on a particular country, but build our own sort of manufacturing strength, particularly in strategic areas. In non-strategic areas,
Trideep, we seem to have...
you can't be the third largest economy in the world when the fighter jet comes from France. You've got to build it on your own. You have to stand up on your 2 feet. So that's how I would answer.
Fair. Anybody wants to ask a question, please feel free, unmute yourself and ask.
So we have one question from one of our clients, and she's asking if you have any views on the new discussion paper, which is around the product, which is talking about a 10 lakh limit. So it's between the space of a mutual fund and a PMS.
I think that is something with Amitabh and Anulekha, two of you will have to think through. I think it makes basically mutual fund the go-to product, and to a large extent kind of impacts the PMS AIF bucket. Because trust me, if you were to offer a PMS like product in MF domain, then the tax advantage that an MF platform gives versus a PMS or an AIF makes the PMS completely uncompetitive. So this is a discussion paper. I think we will see how this translates into a proper regulation. But for now, anybody who is looking to put incremental money into PMS should be careful and see this regulation through and then invest, rather than kind of getting money stuck in there.
Fair. Arvind Thanvi has asked a question. Adoption of AI is a... Arvind, you can ask.
Arvind, kya baat hai? Kya baat hai? Kya baat hai? Boliye.
It's great to see Trideep, you, Amitabh and Anu in the same frame. Okay. So my question is pretty obvious and simple. It's around, how a lot of buzz is around AI. So adoption of AI is a big buzz around. And okay. So adoption of AI is a big bubble, and I would say the reality also. So how do you see this from a future wealth creation and erosion? There are multiple aspects. I think probably my is a very simple that, if we are invested in some of our blue chip organizations, companies, which are pretty much a portfolio companies for most of this thing, from that perspective, as well as, the being invested into those kind of organization, how do we see our position? How do we evaluate this? Plus, what could be the future opportunities in terms of new kind of wealth creating companies, which might be more focusing or maybe, leveraging this wave which is coming up in India?
So इसका एक सीधा जवाब देता हूँ. जब मैं इंडस्ट्री ज्वाइन किया था around about 99 2000, I mean at that time I used to be a tech analyst, and while all of you were minting money in technology, I was a tech analyst, and I know, and everybody would say that Y2K के बाद तो गया इंडियन आईटी इंडस्ट्री का बैंड बज गया, क्योंकि वो तो आने वाला नहीं. हाँ, Y2 के बाद Y2K के इतना सारा इंजीनियर जो यूएस जा रहा है वो क्या करेगा? But then came the package implementation boom. And SAP and Oracle consultant makes ton of money. Then came the SaaS boom. When SAP happened, then people thought अब services की तो जरूरत नहीं पड़ेगी क्योंकि सारा तो पैकेज सॉफ्टवेयर कर जाएगा. लेकिन इंडियन इंडस्ट्री, आईटी सर्विसेज इंडस्ट्री वहां से तो काफी बड़ा हो गया. So मेरा मानना यह है कि AI is one another such trend with at a very economic level. Since the advent of computer will increase, so land, labor, capital and productivity, ये चार इकोनॉमिक जो फैक्टर्स हैं, उसमें अगर आप पिछले 50 साल में देखें, वर्ल्ड में प्रोडक्टिविटी ग्रोथ नहीं आई. The last meaningful productivity growth happened when computers actually entered the landscape. The next productivity boom will happen or is happening once we get AI to a certain level. That's certainly, I think. But in terms of this being a threat, really a threat for bottom end of the IT services. But the example that I gave is that our IT services industry and companies generally have been able to migrate from one trend to the other pretty soon. So while it may gobble up some companies, some other services might become kind of quite meaningful. For instance, if you speak to Infosys, Wipro, they claim about 15 to 20% or more of their revenues come from AI-led services. So जितना services कम हुआ, उससे ज़्यादा उनका बढ़ गया. So net, I think the world or human interference would still be needed. Artificial intelligence can't trump natural stupidity. And as long as there is natural stupidity, there will be people, there will be need for services, and there will be need for people to kind of get cracking with regards to from a services standpoint. Opportunity wise, I think what we are seeing is that a lot of platform based companies or companies that use AI to build on it is coming about in the mid and small cap domain. I can't get into stock specifics here, but it will increase the opportunities of investment over time. And India is a land of entrepreneurs. I mean, look at Amitabh, look at many people, look at yourself. I mean, all of you have sort of turned out to be meaningful entrepreneurs of shape and size. And likewise, you will have more companies leveraging of AI. So I see as a stepladder for success rather than a threat is the moot point, basically.
Fair. Thank you. Thanks a lot.
Thanks, Trideep.
So we have a few more questions coming up on the chat. So folks, you want to unmute yourself and ask, or I can read it out.
Yeah, Trideep, hi, this is Rakesh Ranjan here. I had a question. Since, my thought is all around like Amitabh was saying long-term wealth creation and not, trying to make money in short run. We have been reading about, global warming and sustainable operations. Do you think it's a, right time probably to look at companies or entities who are meaningfully investing in sustainable operations? Because maybe in long term, today it is good to have. Maybe a few years down the line that may become a must to have thing, and it can be a survival thing for the industry. So what's your thought around that? That's question number one. And maybe the second question which I wanted to ask you was, SME stocks have given very good return over short run, or maybe last 1 year or so. Do you think that will continue, or what should be our strategy as an investor towards SME stocks? Thanks.
Book profits is the point I would make.
So just as 1 second, I think a similar question was from Ravi in terms of SME stocks of 1-2 years and long-term horizon of 5 years. So I'm just clubbing those two for this.
I think if there is an area where I could say unequivocally there is bubble, it will be a SME. And I say this because, and over time you will see that's the next area regulator will probably kind of look to strengthen. At the moment, the regulatory oversight on that segment is less, and hence companies are getting away with whatever stories they are making. So if you are making money, trust me, take some money, book profits, and move on. before they turn into kind of something else. So that's my thought on SME. I think I've looked at how things are and the multiples of the stock there is. That certain area one would say, given that where we are, Amitabh's point that liquidity chasing the stocks is certainly valid there. Be mindful of that. The second part or the first question with regards to ESG. Now, I would provide two perspectives. That look, ultimately, people like me as fund managers are looking to make money out of stocks, period. And in that process, what we do is we engage with companies which are not higher up on the ESG spectrum, and ask them to kind of invest in this area, take a step in that direction. But will that be outside because they don't invest? Will that be outside of my investment universe? No. Ultimately, we are here to make money for our investors, and the business trends are far more important than the climate related trends. But what will happen? That's the first perspective. The second perspective I would provide, though, that over time this will lead to some sort of social cost, which will be as part of the P&L. In many ways, if you are a chemicals company, you will have to invest in maybe the gases that you emit to be purified, or to at least take it to a certain level of purity before it goes there. Now that will involve some cost, and that will impact your margins, and that will be brought into your P&L in that form. And hence that has to be sort of looked at from that, ultimately the profitability of the company that we look at. This is the way to bring about climate change and some of these issues into sort of into P&L and invest based on that. So that's second thing. Third, this is of course recorded. I can only be as less formal as it can be, but I would go back to saying that investing trumps ESG. Ultimately, we are here to invest. Companies we engage, but that does not exclude stocks from our analysis.
Thank you. We have a question from Abhijit. Is the forecast for Abhijit, you want to ask, or I can ask? Is the forecast for manufacturing and automotive growth is planned around the infrastructure growth? Can the roads and cities of tomorrow handle the growth? Kindly share your opinion in terms of growth in these sectors.
So let me start with an example, which was appealing to me and to the extent of shocking when I first learned. Let us say that you have a town and you have a village next to it, which are at the moment not connected. But if you just connect a town with the village by a simple road, the GDP of that village goes up 8 to 10 times. This is actually an academic study which has been done, and this is how it turns about. So this is, ladies and gentlemen, the importance of infrastructure. The multiplier of infrastructure is almost 8 to 10 times. Now, we in India live in democracy, and hence what we do is we tend to build infrastructure which is 10 years behind the growth that is actually needed. China, it works the other way around. They work 10 years advance. The good part of the way we go about investing is that we never make almost bad investments. It's almost needed by the time it gets implemented. And hence there is no overcapacity. But having said that, if over the last 5 years, if you look at the infrastructure in the form of airports, in the form of roads, which have been developed in India, they are really par excellence. I think, but despite all of this, today, the logistics cost as a percentage of GDP in India is still about 14%. Developed markets operate at about 5 to 6%. So that's the distance that we need to carry in the form of infrastructure. So some work done, lot remaining.
Fair. 1 second, let me just get back to the chats. So there are a few questions as I can see around. I see a question on petrodollars. Petro dollars from Chetan. Chetan, you want to ask? Or I can ask, he says, I want to ask about the recent news on petrodollars. How will it play in the long run?
What do you mean by petrodollars? So basically, at the moment, petro ruble is the question, not petrodollars. Petrodollars ka to samay ho gaya. But I suppose maybe he wants to ask the question would be great. But otherwise, I think
Sorry.
Yeah,
So what I
go
wanted
ahead.
to ask is, hi. So what I wanted to ask is that I came across a news bit somewhere where petrodollars, which was in force, I believe since 1974, Saudi Arabia did not renew that from the 1st of June of this year, which means that other countries can buy oil from any Middle Eastern countries with their own currency. Does it entail that means the demand for the dollar will fall? So how
Yeah.
does that play out? So I
Yeah.
mean, I'm a layman, so just wanted to understand that.
No. In that context, we all are only a few miles away from each other. But I would say that this de-dollarization as a theme has started, but to materially kind of impact investments and to materially have an impact on business will take almost 30, 40 years. So, for instance, you might have heard that during times of conflict, India actually bought petrol from India bought petrol from Russia and played out in the form of rubles and ultimately gave rupees. Now, the problem really here is that, once Russia received the rupees, that rupees could not be, or the currency could not be used anywhere else for business, because there are very few other transactions across the globe which happen in rupees. So those rupees, the block of money got channelized into stock markets, ultimately driving returns. So net, the point really here is that the global currency for business continues to be dollar. In my opinion, in the next 20 years will remain to be dollar. However, in fringes, like we saw the development of euro over the last 20 years, we are seeing a few other currencies also coming to fore. So these are almost fractional or fragmental trends rather than a mainstream trend. Is my point.
All right. So what you're trying to so that also maybe entails that the value of the dollar really will not diminish in the next near future.
So barring those, I mean, the impact of rate cuts and rate increases, and you will see going up and down in a range structurally. Will that debase dollar? No.
Thank you.
Well,
Thank you.
So I see a question from Nitish. You want to ask? Nitish, if you're asking, you're on mute. Okay. I think his question was that, hi Trideep, with no tax on capital gains up to 1.25 lakhs, do you advise booking the gains annually to avoid any tax?
वो अंग्रेजी में कहावत है ना, penny wise pound foolish. So is the thought that crosses mind that overall, I think जिस stage में India है, whatever excess capital you have which you don't need, if you sort of keep it in market for the next five years, I think you will be in a good spot rather than trying to micromanage the capital gains tax on an annual basis would be my view. Barring that, if there are any short-term funding needs, that certainly can be kind of with the advice of legendary advisors like Amitabh and Anulekha, who can always kind of fine tune that. But I think overall, जिस stage में हम लोग हैं, वहाँ पे पैसा long term के लिए लगाना चाहिए.
Right. Do we have any other questions?
Yeah, this is Dharamveer. Am I audible?
Hey.
Hi,
Yeah, indeed.
Yeah. So I think, a little bit off track, my question, and it's been playing in my mind for a while, not on this call, but before, is that I read somewhere that so far the growth has been a jobless growth. And that jobless growth, and of course, the current budget is a manifestation that has, demonstrates that the present dispensation has addressed it, is that there is a huge youth which is today, really desperately searching for employment. However, unfortunately, they don't come up to the standard because, somewhere we lack the quality education that is required with this, very fast changing world with AI and ML, where people will have to reskill, upskill, learn, unlearn. Because of which also, in fact, I don't have the data, but I did read that the capex that is being put in really by the manufacturing industry is not really so much on job creation, and that capex is also very skewed. Now, having said that, and with this very dynamic situation and geopolitical, socio-economic, and of course, I'm more than convinced that you've kind of navigated through these waters and doing well. But what I mean, it worries me also. These are, situations which may be addressed, not addressed. How much can be forecasted, not forecasted. But from an investor's point of view, 5 years, 10 years, do you still feel that these issues can be weathered and, the story will be good?
I think you hit the nail on the head. If there is a roadblock, it is with regards to reskilling of people and the pace at which we do it, which is why, and BJP's policies, if there is one criticism, it is that ultimately bottom end of the pyramid and also the K-shaped recovery is predominantly driven by the fact that the bottom end of the pyramid did not get addressed in the form of jobs, which is why if you look at the internship program that they have talked about, they're almost giving incentive to the private sector to basically give internship to people. Internship is a way to skill the person relevant to the job. So I think there is a dire need for that coming through. I would rephrase your point saying that the academic institutions have curriculum which are dated versus what is needed, and because what is needed is changing so fast, the 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 profs who are teaching them have to be reskilled to sort of learn, or there has to be additional elective which needs to sort of take care of that, which is something which in one of the panel discussions that IIT Mumbai have talked about. But having said all of this, I think net the moral of the story is that our India's average age is roughly around 27, 28. Around the globe, there are not workers that are available. So, in many ways, as a sort of office of the world, as an offer, as with regards to a demand for people, it is not just in India but also abroad. So, when there is such a demand, usually skilling and reskilling kind of find its place. And companies definitely kind of are looking to invest in this area. So there are companies I remember like Teamlease, and there are others who are kind of working in this direction to create programs to make kids or the youth, the right word, more amenable to the work. So it's a very important social problem. No easy solution, but incrementally we'll probably get there. Internship being the step in the right direction.
Thank you.
So, Trideep, I'm mindful of your time. We are already 10 minutes past that. If you have 5 more minutes, we have a few questions still coming in. Otherwise, we can share the questions and respond later, whichever way you prefer. I know we are 10
5 minutes for you any day, Amitabh.
Thank you. Thank you. So there are 4 or 5 questions more which are there. And of course, if there are people can continue to ask, and whatever we can cover here, we will cover. Rest we will check and get back. There's a question from Pallav. He asks, would you advise moving capital from real estate to mutual fund equity markets for a 5-year term? It's an asset allocation question, actually, more than a, you want to take a, or you want me to answer whichever way you want.
I think you go first. I'll add.
Right. So what we would say is that asset allocation is important. Every asset has its place. Real estate also has its place. The point is that if you have a very significant part of your wealth locked into real estate, then in that case, real estate is not very liquid. So therefore, it makes sense to move some of your investments into the market. However, there is never a case where you are zero into one asset category and all into the other asset category. So therefore, this is a very an asset allocation question rather than whether one should move. So somebody who is high on real estate should move into equity. Somebody who is low on real estate should not move into equity. Trideep, anything you want to add?
No, I think that is the way to go about this. It's a portfolio allocation decision rather than one asset class better than that of other. I would say though, the Gen Zs are generally moving towards equities because of the liquidity part. Because at the end of the day, they want to deal in liquid assets as opposed to illiquid assets, which is where our ancestors were. But that's a trend, is one way to look at it. But having a place to live, as you know, Amitabh, and as I know, is also important. So the truth lies somewhere in the middle.
Sorry, Amitabh, can I please add a quick addendum to that question again? I
Sure.
got your point. So what is the thumb rule for the percentage? So how do I decide that I am over invested in real estate or mutual fund generally? So generally, what's the thumb rule? What percentage should be real estate compared to stocks, equities, and mutual fund?
So a third of your investment. So there is again no right answer. It would depend on different people at different stages of wealth generation, wealth cycle. Somebody whose kids are going for college education may need more in financial assets, less, etc. So there is no straight answer. But if you say as a rule of thumb, a third can be in financial, in real estate. This is excluding your house in which you are staying. I'm talking purely from an investment standpoint.
So, got it. Thank you. And this holds good at the age of 50 plus, but mentally 20. Huh?
It as I said, it's very customized. It's not rule of thumb is a misnomer in finance actually when you look at asset allocation, but it would depend. Of course, all of us are 20.
If it is mentally 20, it's got to be equities, buddy.
Yeah, actually, Trideep has a point.
Go ahead.
Okay, there's a question from Ravi. A lot of HNIs are moving to Dubai and investing from there. How will this impact Indian markets?
Well, as long as they invest in Indian markets, good. Keep them coming. Whether it comes from Dubai, whether it comes from London, whether it comes from US, we are an economy starved of capital. We need to fund ventures like that of Amitabh. To fund entrepreneurs in India, we need more capital. In whichever shape and form it comes, we welcome many and more. So keep it going. But I think if we get this manufacturing-led growth, if we get a few policy continuity right, Amitabh, this is probably a forward-looking statement. 10 to 15 years from now, you would start seeing reverse brain drain happening towards India. I mean, I was in another discussion where a gentleman who was worked with, who was working with AMD, and he was looking to relocate from US to India. I said, wow, that's quite a decision to make. But it's only one data point. We'll see how that comes through.
Right. I think there's a question. Part of it you had already answered. But I'm just saying, maybe if there's anything more to add, what is your opinion on statements such as there is froth in the mid-cap space? We had addressed the small cap space, but there's a question on the mid-cap space.
I think these are nice emotive statements to make, but as hard-nosed practical fund managers, we have to play in the pitch given to us. We can't claim that I will not bat at the other end and I'll only bat at this end, because I know that at the end of the change of over, I will have to go and bat at the others. So I think the moot point here is that yes, there are pockets of irrational exuberance within mid and small caps. Yes, the valuations are high, but so is the growth. So we have to find those pockets within mid and small caps where the valuations are concomitant and commensurate with the earnings growth and invest based on that. I think so far, from that perspective, the market is not outlandish. We can still find opportunities.
Thanks, Trideep. I think there's a question from Abhijit. If someone returned back to India from the state, is it wise to leave the 401k there, or should it be transferred back to India? I think, again, this is a question which, so Abhijit, what we could do, we could have a separate discussion because it may not be suitable for most of the audience here. Again, it's an asset allocation. Again, it depends on whether there are kids, families in US, where is the usage of funds, and so on and so forth. We always advise having a portion of international assets as well in the asset allocation. And that's where Anureka did talk about the Crystal AI as well as an avenue to invest internationally, apart from fund of fund rules, which now have tax benefit again. So the answer to that would again depend on asset allocation, and a very specific discussion can be held on that. Have I missed any questions which are there, or if anybody has any last questions, please ask.
We just have a request from Mr. Bibek to hold a tennis session next with this group.
I think we have a lot of tennis players here in this group, right?
Maybe we should hook
Mr.
up and play.
And
We
Mr.
should just hook up and
Trilokika.
play. You should just hook up and play rather than give
Oh,
summons.
surely. I would love to. If there are, I mean, you're such a fanatic. I mean, most players our age, I think, are slightly fanatical about tennis. So I think we should hook up sometime and play. Just a joke.
Agreed. Agreed.
Sure. Any other question from anybody? Any closing question? Any closing? If not, thanks a lot, Trideep. I think the fact that we overshot our time by a margin again shows the amount of interest which is there, which was there in this discussion. Of course, there may be more questions which will come our way. If there's something, we'll feed it to you. Thanks a lot for the time. Any closing thoughts from you, and then we'll.
No, I think thanks, Amitabh, Aruleka.
Thank
Joining
you, Trideep.
a session organized by you is always precious for me. I have watched on the sidelines your success, and I hope you go from strength to strength, and happy to be a partner in your success in that context. So happy investing, and let's keep in touch.
Thanks a lot.
Thank
Thanks
you.
a lot, everybody, for joining in on this Saturday. Thanks a lot.
Bye-bye.
Thank you.
Bye.
Bye-bye.
Bye.